Good evening, ladies and gentlemen. A very warm welcome to all of you on behalf of BSE Investors Protection Fund and NMIMS Capital Markets, Mumbai. Before we start, I would like to request you all to please stand up for the national anthem.
जन गण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंधु गुजरात मराठा द्राविड़ उत्कल गंगा विंध्य हिमाचल यमुना गंगा उच्छल जलधि तरंगा तब शुभ नामे जागे तब शुभ आशीष मांगे गाहे तब जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
Thank you. Request you to please take your seats. We are pleased to have you all at the BSE International Convention Hall and promise you a stimulating discussion and interaction ahead. This event is organized by the class of MBA Capital Markets, Mumbai, in association with BSE's Investors Protection Fund. Moving ahead under the guidance of Dr. Mayank Joshipura, Chairperson MBA Capital Markets, and Investocraft 2014 team, we have scaled new heights in reaching out to more than 1,000 participants across all B schools pan-India level by organizing, simulating and exciting events like equity research and valuation and various business quizzes. May I request the dignitaries to join us in lighting the lamp and inaugurate the event, please. Thank you, gentlemen. Over the years, Investocraft has managed to bring various eminent and notable stalwarts across the banking and financial services community under one roof. Amongst us today is our guest of honor, Mr. K.R. Choksi, Chairman of K.R. Choksi Shares and Securities Private Limited, who has served the capital markets for over 4 decades now. I would request Shweta to please felicitate him with a bouquet. Thank you, Shweta. Our chief guests for the evening are Dr. Debashish Sanyal, Dean, SBM NMIMS, and Mr. Nayan Mehta, CFO, BSE Limited. Dr. Sanyal possesses graduate-level teaching and academic administration experience of over 25 years. He has contributed significantly towards developing international linkages and launching new programs. Mr. Nayan Mehta, CFO, BSE, has 23 years of experience in the financial markets. Mr. Nayan Mehta is a chartered accountant and the cost and management accountant by qualification. He is also a director of Central Insurance Repository Limited and BOI Shareholding Limited and a member of Audit Review Committee of SEBI. I request Alok and Vatsal to please felicitate them. Please put your hands together, ladies and gentlemen. Thank you, Alok. I would now request Dr. Sanyal to inaugurate the session with his valuable address, please.
Very good evening to everyone. Respected Mr. Choksi, Mr. Mehta, Professor Mayank, Professor Basu, and all the important dignitaries who have come today for this important session of ours. Investocraft, this important function of ours, we are celebrating it for the 7th year now. It's a very important event as far as School of Business Management is concerned. And every year we had the privilege and the blessings of BSc for holding this event over here. And special thanks goes to Mr. Chauhan, Mr. Mehta, and our beloved Mr. Choksi to help us having this event at BSc. We really cherish the support of BSc for having it over here. Thank you very much. And I think we should stand up and give a good round of applause for all the effort put in by BSc. Thank you very much. Thank you very much, everyone. Thank you, thank you, thank you, thank you, thank you, thank you, thank you. This year's topic is changing dynamics of Indian capital market. I was just talking to Mr. Choksi. He's an expert for four decades now. And yes, everyone is looking up. Election is around the corner. Many things is happening. Many things are expected. And dynamism is at its peak. We see a lot of foreign institutional investors are in the market. Some are complaining that why Indian investors are selling it off. I'll leave it to the panel to talk about it. Before I hand over the platform to the panelists, let me talk about our School of Business Management for some time. School of Business Management, friends, as you know, and people who have joined us today, has over last 33 years have been in existence in Indian management map. It has over the years have scaled great heights, and now we are one of the top 7 to 8 institutes in the country. We have the proud privilege of having the support of some 60-odd faculty members of highly recognized, and out of them, over 60% are holding PhD degree or professional degrees. The publication of the school have gone up substantially over the years, and we are aspiring another couple or 2-3 years' time to be accredited by AACSB. Our student strength has increased, and now School of Business Management, about 2,200 students altogether, including part-time and executive programs, excluding the MDP program, of course, we get graduation degree from our school. So that's important which has happened, and that has been possible because of the dedication and support of all who have built the institution over the period of time, and of the corporate world. Corporate world has been so kind to us, and I can tell you with proud, there is not a single day, working day in the institute where a person for the corporate guys, for corporate world doesn't come and address our students. So that is the best part of School of Business Management, is that every day we get some eminent speaker from the industry or the corporate world coming and speaking to my students. And that has made quite a substantial difference in the attitude and the way my students think. I'm also happy to report that this year also, like every year, our placement has been pretty good, and we expect it to be 100% in a short period of time. Actually, most placement has been over, last few are left. And with this, and thanking BSc for once again for helping us to have this program over here, I sign off with a request to the panelists to take up the stage, and a lot of thanks to the students who have worked hard to have this over here. Thank you very much once again.
Thank you very much, sir. May I now request our guest of honor, Mr. Nayan Mehta, to address the audience, please.
Shri Basu, Shri Choksi Sahab, Shri Damani Sahab, Shri Sanyal Sahab, and everybody else, all distinguished guests here. Good evening to everyone. It's my pleasure to welcome all guests along with the team of NMIMS MBA Capital Markets to Investocraft 2014. It is a pleasure to have with us all the noted guests and dignitaries today at this International Convention Hall at BSE. Established in 1875, BSE, formerly known as Bombay Stock Exchange, is Asia's first stock exchange and one of India's leading exchange groups. Over past 139 years, exchange has facilitated the growth of Indian corporate sector by providing it an efficient capital raising platform. This exchange was established as the Native Shares and Stockbrokers Association in 1875. This hall we have gathered today has been witness to development of Indian stock markets over many, many decades. This building itself is a landmark and has been synonymous with the Indian growth story. The association with BSE and Narsi Monji Institute of Management Studies dates back to 2005, with an agreement being signed between both for setting up Center for Capital Market Studies. This collaboration between the two renowned institutions resulted in design and development of curriculum of MBA Capital Markets. The market dynamics are changing every day. As economics of the world get more and more interdependent and integrated, global political issues, commodity prices, US bond yields, Eurozone events, technology advancements, and many other seemingly unconnected events and factors continue to increase their influence on day-to-day market moves as well as its trends, as we have witnessed in the recent past few months. India is amongst the 5 largest economies of the world on the basis of purchasing power parity. Its economy is much more integrated with the world economy than in the past, and it is no longer possible to remain insulated from developments in the global market. I welcome this August gathering of market experts and all distinguished guests and look forward to an insightful discussion on changing dynamics of Indian capital markets. Thank you very much.
Thank you so much, sir. It's an honor for us to be associated with the BSE. It gives me great pleasure to welcome on stage our panelists for the evening. Firstly, I would like to apologize on part of Mr. Jayashankar, who is unable to make it here. He is the Senior Executive Director and Head of Equity Capital Markets at Kotak Investment Banking. He just called us and he said that he's tied up with a few important things, so he cannot make it. So I would like to call Mr. Ramesh Damani first, member of BSE and stock exchange market veteran for over 30 years now. Sir. Yes, sir. Mr. Vikram Seth, Executive Director at Alpine Capital, former Senior VP, ICICI Securities, and a veteran of the capital markets for nearly 2 decades now. Mr. Arjun Marfatia, Senior VP, Inam Asset Management Company Limited, ex-CEO Quantum AMC, and former head of IR TCS. So one seat to your right, please, sir. Sir. So one seat to your right. Thank you. We have Mr. Amit Khurana, Director Research Daulat Capital, previously Fund Manager and VP at ILNFS Portfolio Management. And finally, to take the vacant seat, we have our chairman and moderator for the day, Dr. Paritosh Basu, Senior Professor Finance at SBM NMIMS, former CFO of RCOM and ex-group controller at SR Worldwide. Thank you, sir. Before we start off with the discussion, there's a quick magazine launch that we have. So I would like to take 2 minutes of yours. We are proud to unveil the Investocraft magazine for the year 2014, which is an emblem of sheer dedication of the students of the capital markets. The magazine is a collection of the choicest articles written by students from NMIMS and from B schools across the country on a variety of topics. We request all the dignitaries to please come on the dais for one more time and inaugurate the Investocraft magazine 2014. I would request Pratik Jain and Chakshu to please bring the magazines for inauguration. Round of applause, ladies and gentlemen, please. Let's continue it till the magazine is unveiled. Thank you. Let us now begin with the most awaited session of the evening, the panel discussion for Investocraft 2014 under the theme, The Changing Dynamics of the Indian Capital Markets. It's over to you, Dr. Basu.
Thank you, Ram. As we always begin our session with the cheer up, as the market is cheering up, let us also cheer up for the evening. Let's cheer up for all. We have with us our distinguished panelists. We are missing Joy. The message will be sent to him that we will really miss him and throughout the panel discussion. So I will be starting with Mr. Damani. First thing first, okay. Do you think we have started getting some signals from the market, the way it is behaving? Do you think that the last upgradation of BNP Paribas and the recent overweight by Goldman Sachs, is it giving us some indication?
Yeah, thank you, Professor. Are you hearing me? Voice coming? Great. Great. Thank you, and thank you very much for asking me to be a part of the panelists. With Kishan Bhai sitting there, it's a huge responsibility on my head because he's the veteran of the Bombay Stock Exchange. The question was, are we getting some new signals from the market? And I think the answer is yes, we are getting some new signals from the market. You know, you've all witnessed the magic of an eclipse, say, in nature. It's one of the great shows when you see a solar eclipse taking place in the middle of daylight. You'll have darkness, and then you'll have the birds chirping, and then suddenly light will come out again. A wonder in the financial markets, the equivalent of nature's eclipse is what we call a bull market in the financial markets. A bull market changes the destiny of a country, the destiny of its people within the country, very certainly the destiny of various industries within the company. Just take a look at the history of bull markets in India. In the 92 bull market, which is so-called the Harshad Mehta bull market, it foreshadowed that India would be a liberalized country, that the static economic model of the 1970s and 80s was giving way to a new free market economy, which came true in 1993 when Manmohan Singh delivered his famous dream budget. Just remember that he delivered the budget in 1993. The market already had peaked out in 1992. So markets tend to be way ahead of the general economy. Again, the 2000 bull market which took the Sensex temporarily up to 6,000 level, foreshadowed a great boom in technology, that India was going to become a technological superpower. Again, I think Infosys is about 10 times the size it was in 2000. And yet the index at that time reached 6,000 before that. And this 2004 bull market that started, that took the index basically from 4,000 to 20,000, foreshadowed a new liberalized economy, a new confident India, India finding its place in the world, all of which has remarkably come to pass. So the question is, now that we hit 20,000, say in 2008-9, and then for 5 years you went nowhere, 6 years you got nowhere, and now the index has made a record high just a few days back. That typically suggests better times ahead, that a bull market is being born, and a bull market typically will take the index significantly higher than its previous stop. So the previous stop is 20,000. If this is a genuinely bull market, it should take it much higher. Now every bull market, sir, must have a hypothesis on what is the basis. And I think the basis is that India is going, a population of 1.2 billion will become a middle-class consuming country with perhaps a middle class as big as 500 million people in the middle class in India. And if you believe that hypothesis, if you believe that a per capita income, which is now about $1,000, $1,200, depending on the statistic you believe in, will go to 4,000 or 5,000, it will trigger a rash of great J-curve-like growth in various businesses, from housing, education, travel, automobiles, and under a variety of scenarios. So it is an exciting time to be investing in India. The undertone of the market suggests that we are in a bull market. The reasons for the bull market tend to become clearer 6 months, 1 year down the road. It is a good opportunity for most of you, if you're not investing in India, to start investing, because you'll all be getting your first paycheck soon. And I'll get into this later on in the discussion. But the sooner you start investing in equities, you know, the more prosperous you'll be by the time you need that money really for your own children's education, for your own children's marriage, for your own retirement. So my advice to you all is to pay heed to the signs of the market. We are perhaps unwrapping a brand new bull market. A bull market is a very exciting time to be investing in the stock market, and take advantage of this great opportunity that the market is offering you all.
Thank you. Gurudev Rabindranath said that paschathe rakhitho jare she tomare paschathe taniche. Means if you keep somebody behind you, then that person will pull you back, and that's what we have seen in the backward states and backward areas of India. I don't think the large cap will keep the mid cap and small cap any more time behind. And we are seeing lots and lots of activities in the small cap and mid cap areas. Do you think that the recent indices change in small cap and mid cap areas is indicating towards a vibrant and broad-based Indian capital market? And the question, if it is so that they are trying to come up, do you think that there is something to be done by the government, SEBI, and the market players to bring them also to make Indian capital market a really broad-based one?
Yeah. Thank you, Basu. It's an interesting question that goes into the heart of so many issues that we deal every day in the stock market. I became a member of this esteemed institution in 1989, which is about 25 years ago. And at that time, if you look back in the last 25 years, which was the greatest stock that you could have invested in from 89 until 2014? And if any of you have the answers, you can raise your hand. Now, Kishan Bhai would know, but he can't answer this question. Anyone else? Anyone has an idea out here? It's a very good answer, but it got listed in 93. It wasn't listed in 89. Infosys has been the best compounder, almost 59% CAGR over 20 years or so. Wipro, yes, but doesn't meet quite that qualification. But it's among the top 5. Yeah, thank you very much. What's your name? Give him a round of applause. Great, great answer. ITC has gone from something like 250 crores market cap to 250,000 crores market cap. It's been one of the most stunning stock market performances in this time. The point I'm trying to make in answer to Professor Basu's question is that it was at that time a small cap, relatively speaking now. The company had a very modest market cap. Infosys, which got listed in 93, do you know what the market cap was of Infosys in 93 when it got listed? Any guesses? Who answered Infosys there? Yeah, you answered. What is the market cap in Infosys on the day of the listing? On the day of the IPO, let's say. Take a guess. It's today about 2,50,000 crores. 20 years after the IPO, it's 2,50,000 crores. What was the market cap? Well, I'll tell you. The market cap on that stunning, beautiful day in 1993, when it got listed, was 30 crore rupees. All right? So here's an example of a small cap becoming a large cap. All right? So the trick is always to find these small cap companies that will end up becoming large cap companies over time. It's a misnomer to think that you always want to invest in a small cap or invest in large cap companies. As a business person, you want to invest in value, right? Sometimes you get value in a large cap company, means large market capitalized company. Sometimes in a small cap company. As I demonstrated to you, ITC and Infosys, very small cap companies over the last 25 years, but they become phenomenally large cap companies, Sensex 30 companies over the next 20, 25 years. So the question I'm often asked is that, Ramesh, you were very lucky. You came to India in 1989, the economy liberalized, you got a big technology boom, you made tons of money, but are similar opportunities available to students of today? And the question unequivocally is that yes, there are more opportunities available today than they were 25 years ago. Just think of it, 10 years ago, none of you had heard of Google, none of you had heard of Facebook, none of you had heard of so many companies that are now part of our everyday life. There will be driverless cars in the future, there will be biotechnology companies in the future. And given the India's size of the economy and the importance in the place of the economy, investment opportunities will multiply. So to answer the professor's question, that yes, there's a certain vibrancy in the Indian stock market now after a 4 or 5 period of years of consolidation. There are ample opportunities in small cap, large cap, in the digital economy. All you have to do is to look and try and find a great business, because for all of you, the opportunities are equally great.
Thank you. I go back to Calcutta in the days when I used to be in school. Around this time of the year, April, May, there used to be some bit of a lull in the afternoon time. And we thought that, okay, this is the time for the mango to fall and we should go back. But the lull used to be a little longer and the storm used to be good bigger. Let me come to you, Vikram. Is it the lull which we are seeing in the market today in terms of no IPO coming, no listing happening, except a couple of you about a year back? Is it the lull looking for or indicating towards a big thunderstorm? Because Indian entire economy is looking for whosoever comes, whatsoever may be the color in the seat of power tomorrow, there will be a lot of capital expenditure. There is a lot of money flowing into it. And as you know, banks and financial institutions will alone not be able to make that good. Do you think that we are ready for lots and lots of IPO activities in the Indian capital market? Do you think the stage is ready for that, and what all students can do in future on this?
Thanks, Dr. Basu. I think there are a lot of lessons we learn when we go back and see what happened in the last 15, 17 years. That's what my career span is all about. I think when I was being introduced, what got left out was I'm also an alumnus from NMIMS, the batch of 1996. There's a reason why I'm saying this. 1996, the finance industry was as disillusioned as maybe what it was a couple of months back. Maybe the last 2 months, we've seen a lot of activity, at least in the secondary markets. While we were going for our campus interviews, we had to fight with the registrar of the institute saying we cannot afford job losses because hamara ek koi bhai jobless reh jayega. I think that is where the scenario was. I hope the scenario is far better today. Coming back to what happened thereafter, the level of activity that is there in the capital markets today, which is, unfortunately, we are all restricting ourselves when it comes to capital markets. I think there's a mental mindset that we have. When we talk of capital markets, we're talking of equity capital markets. We talk about what the numbers that hit us hard is Sensex and maybe today Nifty. I mean, we'll say Sensex close to 22,000, all-time high. What has that got to do with the vibrancy of the markets? It has got nothing. Today, we're not seeing IPOs, we're not seeing QIPs, we're not seeing any investor sentiment improve. Maybe because there is a 0-1 sum game that is likely to happen in the next couple of months, which most of us are anxiously and optimistically waiting for. Leaving that aside, irrespective of what happens on the political scenario, is India going to stop or Indian corporates not want to expand? Definitely not. The answer is a clear no on that front. We will require capital, we will require capital markets. To address this in a slightly different manner, what are retail investors today doing? Is the money just not there in capital markets? I think I want to give a larger connotation to the capital markets today. Indian retail investors are putting their money in different forms of capital deployment. We've seen debt, which is now trying to mature into another form of capital market. We've seen large debt issuances where retail investors have participated. We've also seen in the last 10 years, we've seen retail investors being able to access other forms of markets which they could never do so, like the commodities market. Imagine a retail sophisticated investor investing in rural India into guar gum. That is what is happening today. We are seeing him invest in a sophisticated manner through ETFs into gold. I think the point that I'm trying to make is today an investor has a far large number of asset classes to choose from which were not available to him in a very sophisticated manner 10 years back or maybe 15 years back. And that is, I think, going to change. Even the definition of a retail investor in the Indian context is changing. Our regulators, in some case, say 1 lakh rupees or 2 lakh rupees is what a retail investor is classified as. The second thing, in a debt issuance, anything less than 10 lakh rupees is where a retail investor gets classified as. So when we look at, I think what we're looking at is the bottom end of the pyramid in terms of deployment of capital. The person who deploys the least amount of capital in an issuance is what we will classify here as a retail investor. The risk-taking appetite of these investors is changing. So the moment we see that can I get 12%, 15% returns, we will see them come back and invest in IPOs. I think that is where, so you move money from an 8 or 9% secured government bond to a 15, 18% kind of an instrument where you think the rewards are going to be far better, where you think that these rewards or this is something almost certain. And that's where you will see once again the vibrancy of the capital markets. The level of activity that is there today in the capital markets, when I'm saying capital markets here, I'm talking of equity capital markets, is back to 2001-2 era, where you used to see 2, 5, 8 public issues in a particular year. What happened in 2007? At what I would say the end of a particular bull run at that time, 2007, 2008, in a particular issuance, which was more than 10,000 crores of issuance, we saw 50 lakh retail applicants coming back to the markets trying to invest in that paper. So definitely, this is a wave, this is a cycle. And once the cycle comes back, we're sure to see a lot more vibrancy across all investment classes. The difference being that instead of just one asset class, we will now look at or have to do a balancing act across all asset classes.
Thank you, Vikram. Arjun, now let me come back to you. When Steel Authority Limited share came to ₹5, we saw an excellent ad. There is every bit of steel in everybody's life. And we found that ad that a child is sleeping with a nappy and there is a safety pin, and that indicates that Steel Authority is present in everybody's life. Similarly, technology has started touching everybody's life. If you go to Chroma store, you find a 3-year kid playing with an iPad and all. So there is a tremendous amount of technology touch in the capital market area also. And we find that It has brought in lot of vibration, lot of metamorphosis, lot of speed, lot of quality, lot of security, lot of protections to the investors' world. And it is transforming the entire dynamics. Sitting anywhere in the corner of the world, you can buy a stock exchange, sit in Bombay. What do you think? How do you think that this transformation has taken place, and where it is going to take us forward to?
See, this is yeah. Technology is all pervading, as we all know, and I'm sure the audience here is probably more familiar with me than what what I will know about technology. But having been in TCS and having worked on electronic trading platforms and written about them, what I will say is technology is all pervading. It has transformed everything and touched every sphere of life. In fact, the room where we are sitting here, I mean, Kishan bhai here and I think Ramesh bhai will know that we used to actually trade in this room, okay? So we used to have a pink book for the members, I think a blue or a white book, I think, Kishan bhai, right? If I recall, that the jobbers of people used to carry, you would trade, market was open for 2 hours, and you went back, you punched, there were errors, and you resolved them. Today, as Dr. Basu rightly said, you're trading anywhere in the world. You're trading with your mobile. You have direct trading platforms whereby an institutional investor, or even a person like you and me, is given an internet software. You trade directly. Your order goes straight to the exchange. It is matched and you can trade. That is one transformation. Second, globalization. Today you can trade with the sun. The sun rises in Japan or Australia. As the sunrise moves, Korea, Singapore, Hong Kong, India, Middle East, Europe, USA, East Coast, West Coast, again back to Japan. So you're virtually trading 24/7. What does that imply? Speed, accuracy, at the same time, a tremendously high probability of huge errors taking place, where people have got hit very badly financially because instead of 1,000, somebody keys in 100,000. Mistakes do happen in trading, and the stalwarts here who actually run trading operations know those are real possibilities. The advantages, knowledge is disseminated almost instantaneously. You don't have a level playing field. It is not possible. That's in theory, but to a large extent you have it. What does all this mean? It has completely changed the dynamics of the capital markets. You have debt trading, you have equity trading, commodity trading. Everything is electronic. That leads to much higher volumes of trade. You have very high speed trading. At the same time, the back end of trading has also taken place, is that your processing takes place rapidly. You used to have 15-day trading cycles. Today you have T+2. That means I trade today, 2 days from now, I get the stocks, I get the money. So your risks are reduced. But with globalization, one event somewhere in the US has the ability to impact the markets across the globe. So the risks have to be managed very, very prudently, very actively. Regulations have changed, which have led to very highly focused and I would say, very innovative ways to manage risk. Surveillance systems have come into place. A lot of innovation has also taken place. I mean, I think Mr. Sheth mentioned that you have commodity trading, you have ETF trading. You also have fixed, even for debt markets, you have fixed maturity plans. You have capital protection plans. So all sorts of new products, all this is due to technology. And that's how your entire capital markets, why India across the globe has changed for the better. So that is the impact of technology and the dynamics which come into play into the capital markets. At the same time, the quality of people has gone up in a huge way. Talk of research, I think I remember that Kishan bhai used to be among the pioneers in equity research. And analyze companies, ask the right questions at AGMs, publish the right reports. And today they are available everywhere. Bloomberg has it. You get it on Money Control for free. People submit their research to be studied. So there's a plethora of information which was not available maybe 20, 25 years back. I think 89 or 90, research was an alien concept. Today you have research. And as Amit heads the research, is very, very sharp, very focused, and from experience of investor relations, I can tell you it's a tough time to deal with the analysts. We've got young kids who are very, very sharp and ask very pointed and precise questions. So you have research. The quality of people, as I was mentioning, you had uneducated people trading here with finger signs, writing down things. Today, you have MBAs and engineers getting into trading. In the US, you have nuclear physicists and mathematicians who are developing trading algorithms. And they're using extremely high-end computers for having automatic trading. They're trading in fractions of cents and dollars. And the volumes are huge, and they're making money. So it's the complete dynamics of operating the market, the very nature of the capital markets, and our life has changed due to technology.
Thank you, Arjun. Amit, you are an odd man out here, and I'm sorry I will be asking you a very pretty odd question here. And right or wrong, there is an old school of thought, and the school of thought is coming back again, that this analyst guys, these research guys can make or break a price and a quantity of trading in the market. It used to be a nightmarish experience of mine, both sitting abroad and India, when an earnings call goes out and thereafter showers of questions like the showers of Mumbai used to come, and used to sit, midnight candle used to burn, used to prepare answer. Do you think that in India there is continuous noise trading going on? Are the research guys the triggers for noise trading? Is it really making any impact? Our students would be definitely look for this analysis from you. And after this analysis, could you please tell us that is there a necessity of a self-inflicted discipline there for the research guys, the so-called quote-unquote analysts activism and nightmarish activities on the other side of the table of the CFO? Do you think any regulation is required? Do you think another regulator is required to bring them into some disciplinary mode, and so that they cannot make or break things, they really be the friends of investors?
One more reason for you not to become a research analyst now. Analyst bashing is always the favorites of whosoever you deal with. So don't become a research analyst. Believe me.
That is not the idea.
Your clients will not like you because you keep calling them up every day in, day out. The corporates will not like you. Your wife is not going to like it. Your family is not going to like it. But people still have a lot of glamour value attached to the industry. And to answer your question, Professor Basu, I think it's important to understand why the industry behaves the way it does. Why do the analysts tend to be so persistent with the kind of work that they do, with the kind of follow-up that they do at the client end or the corporate end? I think it's ultimately money is involved. And wherever money is involved, there's a huge amount of responsibility that naturally comes into play, because when you're servicing the buy side, the fund managers, the CIOs, the international investors, you really need to be up to date, up to mark on each and every aspect of the stock or the sector that you're writing upon. Any slip up means that you're rating your credibility and your whole position before the client will go down dramatically, and then there's no second chance in this industry. So that's probably one of the reasons people tend to be extremely persistent. And as Arjun said, that industry has obviously moved on. The kind of questions, the kind of analysis which is done has obviously improved dramatically. I remember the mid-90s when I started my career. My day target used to be to get a fax of the half-yearly earnings from a particular company, and that used to be my KRA for the day. So if I could source the facts during the day the result came out, your job was done. But I guess things are very different now. Information is available instantly on channels. It's instantly available as a part of the regulatory requirements. So things are very different. To come to the question of the self-inflicted, I would probably say self-imposed versus self-inflicted. I think, yes, I personally do believe that there is a requirement for the analyst community, for the research community, whether it's buy side, sell side, or the research outsourcing agencies, to have some sort of a code of ethics and regulation. The reason I say that is that ultimately you're going to realize whether you're a buy-side analyst or a sell-side analyst, your inputs, your advice, your report that you're going to be putting out on is going to help somebody make a decision which has huge financial implications for the person who's invested that money. So for example, if you're servicing as a sell-side analyst to a fund manager, that fund manager is going to be taking decisions whether to buy or sell a stock, whether to go long or short on a particular sector based on your inputs. And that money belongs to somebody else. So there is a huge amount of responsibility on you to do your homework right, get the facts and figures right, and be able to add qualitatively and analytical level a certain level of input which helps the client or the money manager take a fair decision. However, whether it will happen in the near term, the regulation part, the self-regulation part, whether it will happen in the near term, I probably have some reservations about it, primarily because till now we haven't got any guidelines from the regulator which are formally prescribed for the analyst to operate. There is a policy paper which is currently under discussion. It's been put up for public discourse. And hopefully once we get that out of the way, and that gets into industry practice, and that's a pretty comprehensive paper, which will address the issues of conflict of interest, analyst holdings, analyst certification, which is extremely important, which is currently not prevalent in India, and that is going to be addressed in that particular regulation, will come into play, and I guess then industry will probably have to take a stance on having some sort of a self-imposed regulation and understanding that these are the practices that we will follow, and these are the processes that we will follow to ensure that the stuff that we put out there as recommendations is clear, concise, and makes a material difference to the person who reads it, whether it's a fund manager, whether it's a retail investor, or whether it is whosoever it is.
Thank you. I think that will bring a lot of work-life balance in the field of not only analysts but also CFOs of the future years. Thank you so much. Let us change the dais. Let us change our citus of discussion. Let us go through the shores of India and look at the world window. Vikram, you and Ramesh, both of you can join this question. I was reading a paper published by McKinsey where they have said that there is an increasing deterioration in the hands of the retail investors to allocate money for equity capital. And the publication said that worldwide, $37.4 trillion of equity requirement from the corporate sector will be chasing a sum of $25.2 trillion. That means there will be a gap of roughly about half of the requirement. The scenario is not that bad in the developed countries, but the scenario is bad in African countries and also in Latin America. But the most important scenario, they have predicted that so far as the requirements of the emerging countries are concerned altogether, it will be a requirement of roughly about $10.5 trillion, and that will be chasing only an allocation of $3.5 trillion. So the reason they have identified is very simple, three. One is minority shareholders' interests getting disregarded. The second is substandard corporate governance. And third is the return on investment. What I think and what I personally feel, and you can also join to this question with one or two comments here and there, that a lot of things to be done in India if India wants to bring in a lot of retail investors to market. Could you give us a count of what is happening in India and what is expected to happen in India, and what are your suggestions to the future regulators and government on this? Vikram, to start with you, and then Ramesh, you can join.
Sure, thank you. I think I'll just twist the question a little bit, where your suggestion has been to figure out what regulators, etc. can do. I think what I would first like to focus on is what's happened in the last few years again, and where we have, or what we have done when it comes to regulations, when it comes to disclosures. Somewhere in the late 80s or the early 90s, a company that was going for a public issue, the DRHP, or there was no term as DRHP also, I don't even know what that term was. It may be called a prospectus, was maybe 35, 40 pages, out of which 6 or 7 were devoted to who has underwritten the issue. Today, that same document is somewhere close to 350 to 400 pages kind of a thing. So there is enough and more that the regulators have forced in terms of information. A lot of information is available. On the contrary, there is so much of information that no one has time to read that information before investing. So then they have suggested, let's come up with a 10-page executive summary so that someone can at least read that executive summary and invest. My question to investors, especially after investing and you've lost money, did you spend even 5% of the time? So if you are earning, say, 2 lakh rupees a month and you're investing 1 lakh rupees into a particular public issue, what amount of time should you invest? So to earn 2 lakhs, you've slogged through a full month. To invest 1 lakh, how much time have you invested? Practically, a lot of that investment happens because you have overheard a friend in the local train while coming to office, ये अच्छा issue है, इसमें भरना चाहिए. This is exactly the parlance that happens. Who is to be blamed in that case? Is it the regulator? Is it the corporates? There is enough hue and cry that we are talking about corporate governance. Practically, a lot of information is available. Have you even ever figured out or had the chance to go through the information that is there in the public domain? Thanks to Google, thanks to enough softwares that are available, there's so much of information. So I think the first and foremost is, I am not in, regulation is good. Anything in excess is poison. This is not something which I have said. This is one of our freedom fighters had said on a very macro basis. Anything in excess is poison. So yes, regulation is good. Self-regulation is even better. But at the same time, the person who is investing, he or she should be the one who should be bothered about what they are investing in. And this goes across all asset classes. You will have financial advisors, you will have brokerage houses, you will have research analysts. Have you even figured out what the research analyst is saying? Paisa dal diya, at the end of the day, you lose money and then you say, oh, this was wrong. The same company in which you may be investing, the disclosures will say there is a CBI inquiry, he's a politically affiliated person, he is X, he is Y, there are 40 criminal cases against him, and tomorrow he gets convicted in one of those and goes behind bars, and then the stock price comes down from 400 rupees to 40 rupees in 10 days' time, and then you say, oh boss, there is no corporate governance in this country. I'm not sure. I think all our standards are very good international standards. We have, in my mind, we have borrowed a lot of those good practices in the Indian context. There may be a long way to go, or there may be some way to go, but I'm not excessive regulation. I'm saying, I'm using the words very clearly, excessive regulation. Excessive, and why I'm saying this, let's look at an investor's psyche out here. The psyche is just between two words. Everything that he sees around can be ultimately summarized in two words, fear and greed. What does the regulation do? It's just putting fear and fear and fear. Unless there is some element of greed. And the greed is also aspirational. Today I want to grow at 30%. Today my salary should grow by 40%. That's aspirational. As long as that greed is there, balanced by some element of fear, and I'm saying some element of fear, it will be a balanced market. So today I think we have an environment where sometimes fear, because of excessive regulation, is killing the markets. I think that's what I had to say. Over to Mr. Tamar.
Quick comment from you. Very quick.
The pendulum always swings the full arc. And I'll only tell you one thing. There are lots of issues that he raised that we can debate. But the important thing you all need to understand is that the government has already made equity investing very attractive in India. Please listen to me. Dividends are tax-free in your hands, okay? It's tax-free. Capital gains, long-term capital gains, we held it for 1 year, it's tax-free, all right? Nowhere else in this country or in any other country in the world, you get such a favorable treatment as an equity investor. If you do in a fixed deposit in any of the banks in India, you get 9% fixed deposit, 30% goes off the top to Government of India in income tax. But dividends, and I can build you a portfolio of high quality blue chips at 3, 4, 5% yield. plus long-term capital gains. Infosys and ITC were up 2,500 times in a period of 25 years. And if you had 100 shares, it was worth 25 lakhs today from 2,500. And the tax consequences for all of you are zero. All right? Please listen. When you're young, you want your money to save and build your capital. There is no better way to build it than tax-free. All right? So there are lots of issues we can debate with him. But the most important lesson in all of this is that equities for young people, great businesses compound over time. So buy some great businesses.
Thank you. One or two quick from you two. Very quick on this issue. Then we'll come back to the next point.
I think Mr. Damani has said it all. I think it's absolutely, I mean, that's the way you've got to be looking at businesses and allocating capital. Of course, one has got to do it in a very, very calculated manner. Make sure that you're aware of the risks. Make sure you're aware of the companies. Do your homework well, and hopefully, things will work out for you. And of course, have realistic expectations. I mean, you can't make 50% or 100% every year. So you've got to be realistic. I mean, the BSE Sensex, if you were to do a 34-year analysis, probably has given 17-18% CAGR. I mean, imagine the kind of power of compounding, the kind of returns you will make if you were to make that kind of a return consistently on your portfolios.
Shall we go to the next question? Again, Ramesh, I'll come to you. I was one of those who looked along with the promoters of SR Group to look outbound. In fact, there were many outbound IPOs by Vedanta and by Infosys and MakeMyTrip.com, those kind of people. So there were a lot of promoters who went abroad for raising equity since money was not found and investors were not interested. Now those could not be sustained anymore because of many reasons. Let's not get into that. What one is looking for when the capital investment spree will come to India, do you think that a stage is already laid out in the Indian capital market to fund those capital expenditure by garnering from the retail investors' resources? Or Indian promoters will have to continuously look outbound and go for their fortune with other stock exchanges. Of course, we understand one thing, that if you have to do a metal and you have to go to Ontario, you have to do ITES, you have to go to New York, etc., etc. But will it be a mix of outbound versus inbound IPOs, or it will be more of activities in India?
It's a long and complicated question, but prior to the 1990s, India was a closed economy. And BSE was one of the few institutions that stood for free markets. The Infosys of the world, the Reliance of the world, the ITC of the world came to the BSE, raised capital and built the businesses. Right? That changed in 92 as the rupee became convertible on the capital account. One more trend took place in the world, which is what is called digitization. That means who is best suited to do the job does it wherever it is suited to do the job. That's the reason why I got such a big IT industry going out of India. Because of digitization. Cheap telecom, digitization, the work was sent to India, shipped back, it was done in night in America, shipped back in the day to America. So capital will now go where it's most needed and most efficiently used. And these concepts of national boundaries, concept of India, concept of America, are becoming increasingly blurred over periods of time. So my thought process is that we should make the currency convertible. The reason we are not making convertible because then we can't go into huge deficit spending plans, huge deficit spending sprees, huge social budgets that we do in this country. We make it convertible, come up with a fiscal budget, then capital will go freely. India will go and buy Chorus, Vodafone will come and buy India without any great court or legal cases out there, which is the way it should be. If an Indian entrepreneur feels he can run Jaguar and make it a global brand, as the Tatas have demonstrated, he has had the right to do that. Someone wants to come in India and set the cat among the pigeons in the telecom market, why should he not be allowed to do that? Why should legal and court cases stymie this person for 8 to 10 years? So if the governments don't recognize that, India will become a backwater again. So we must open up our markets, open up our currency, and not fear the world. I think Indian entrepreneurial talent, the number of CEOs now heading companies, Harvard Business School, MasterCard, Microsoft recently, right? There's a wealth of talent in this country that can run global enterprises, and unless we open it up, it's not going to happen, sir.
Ramesh, I think you are right. PwC has published a report but that by 2025, the developed countries, in terms of their own capital requirement, and I can imagine that by 2025, those countries will come back into investment spree, will require a lot of money to be picked up from developed countries like Brazil, China, and India. And their predictions are to the extent of roughly about 30 to 60% of world capital requirement will be supplied by these countries, Brazil, China, India, to a certain extent India. Because in those countries at that time, the availability of investor surplus will not be there. I'm coming to you, Vikram, and I'm trying to ask you a question. You are definitely a protagonist of not too much of regulations, etc. But when they have interviewed 387 specialists like all of you sitting here, they have found that 56% of them voted that there is uncertainty of regulation requirement which has to be corrected. 33% is talking about unstable political environment, and fear of government intervention is talked about by about 27% of the people. The point I'm trying to make is that I'm pretty sure that with the kind of transparency India had, I'm very ambitious about India attracting more than 30 to 35% of those IPO shares by 2025 in India. Do you think that the stage is set, or the trend which is going on today will make the stage by 2025 to be India as one of the best investors' destination? What is your view about it? What do you take home from it?
I think there are a couple of points. One is whether India will continue to remain an attractive destination or not. And the other thing that we're trying to do this is whether our regulations and our framework and the government out here will do enough to attract if India has to remain to be a preferred destination. So I think my views on this are fairly simple, that when it comes to the regulatory part, let me address that first. What the regulation does is, assuming everything else remains the same, and I think I'll just take a little bit of an example to your earlier question, is when Indian companies went out to raise resources, which was maybe through GDRs or any of those kind of things, what the regulations, or why that trend was not seen thereafter, was because the Indian regulators allowed a very similar product in the Indian context, which was a QIP. So which means that I don't need to go out and get listed on an LSE or a Singapore Stock Exchange. I can still do this at quick speed within 3 months' time or 2 months' time, the same way a GDR would have been done in the Indian context. So whatever regulatory issues were there, we removed those. Today, we are not seeing the same capital being raised in India. So what the regulator here has done is saying Indian corporates without getting listed in India can go and can raise capital abroad as its first listing kind of a thing. So the regulation is only helping in reducing what I would say, or the pains for a particular corporate, or is inducing the corporate to behave in a particular manner. There is something what we call as regulatory arbitrage. To go back to the regulatory arbitrage, the way an investor looks at it is what Mr. Damani said, that today equities attracts no capital gains when it comes to long-term capital gains. That's in one form a regulatory arbitrage. Why did the debt mutual fund industry in the last 1.5 or 2 years thrive so much? Because on debt mutual funds there was there was a 10% dividend payout that had to be paid, whereas in other cases there would have been 27% kind of a thing. I may be slightly wrong, but there was a regulatory arbitrage. Coming back to the larger question of will India remain a preferred destination, I think the answer to that is not a very simple answer. Today, we are in a fairly large global environment. India happens to be one of the nations trying to attract capital for its growth based on its own internal needs, based on its demographics kind of a thing. Flow of external capital to India will also depend on what happens to their own economies. So if I'm seeing a good steady 6% growth sitting out of US and a 9% growth in India, would I still invest as a fund manager in India? based on whatever is the evidence today, I think this question has gained a lot of importance today, and the milestones that you have mentioned out there is because of certain overhang relating to tax issues, relating to one of the large corporates in India. Has that stemmed the investment sentiment towards India from a corporate point of view? The fact is, when we go outside India, yes, it has. Will it continue that way? I think today, based on what Dr. Basu said, whichever political party comes to power, and again, I don't want to be a political economist here, they will have to treat, one thing that is very clear, they will have to treat the markets and they will have to treat businesses and corporates in a very business-oriented CEO kind of a thing. And which means that if they don't do that and the CEO needs to get replaced, whether it be the top 10 companies in the global list, I mean, we see CEOs changing in very global companies, which is still growing. Way, the CEOs of India Inc. will change if they don't do that. The answer to all this is yes, India will see lots of sustained growth. I'm an eternal optimist that we will see growth. Whatever are the regulatory issues, whatever are the intrinsic growth issues that we see out here are fairly sentimental in nature. The moment we see regulatory issues, the moment we see a little bit of stability out here at our end, we should be again thumping back at more than 8-9% kind of a thing. It may not happen in 3 months' time, it may not happen in 6 months' time, but if we're talking of 2020, we're certainly there. All the students out there, you guys have a fantastic time. Hopefully the worst is behind you guys.
Thank you, Vikram. Please. Very quick, just a 2-minute comment.
Add to what Mr. Sheth and Mr. Damani have said. See, if you look at international investors, they have the globe as their investing opportunity. The returns which they are getting there in the past few years have been 2%, 3%. You look at India, your debt markets have been paying you about 10%, 9%. If you look at equity markets, as Amit just mentioned, 13, 14%. And this year the markets have done about, I think, 15 to 18%, if you look at all the three indices. So the opportunities for growth and returns in India are phenomenal. Europe was nearly written off. Japan is still struggling to get back on its feet. US is still struggling. So India is the opportunity, and the FI data, if you see in the last 20 years where FIs have been investing in India, only in 2 years they have withdrawn. One was sometime in 91, 92, I think, at that time, and the last was in the global meltdown in 2009. Otherwise, every year, without fail, there have been huge inflows into the country. If you look at the FI holdings and the promoter holdings, the Indian retail investors' holdings is minuscule. If you look at Reliance Industries, I think 23 lakh shareholders are there, roughly. How many shareholders do you think, apart from promoters and related parties, own more than 10,000 shares in the company? Anyone take a guess? 23 lakh shareholders totally. Retail individuals like you and me, how many do you think hold more than 10,000 shares or close to 10,000 shares? Anyone take a guess? Give me a number. Sorry? 300? Not that bad. It's about 1,300. So you see, the scope for retail investing is phenomenal.
Okay. I think if India grows by about 8 to 9%, again comes back, the West definitely can look at India by 2025 to pick up investable surplus from here for developing the countries. What is called FII or FDI today in the context of India, India will be seen as a contributor to FDI and FII in future. That's what is I'm trying to look at, and PwC is perhaps trying to look at. I'll come to you again, Arjun, with a very interesting question, and that's today's research report. Of course, this question is haunting us, and I'm sure Professor Mayank in his valedictory comments will definitely cover this point. What is being seen that in 1980s, 15% used to be the churn in BSE Sensex participants. And nowadays, we have seen last decade about 50%, whereas Dow Jones, Hang Seng, and Bovespa Brazil, they have churned by 23, 30, and 39%. So that seems to be value investing and growth investing and retention being more, that's why the participant in the indexes were not changed much as is being changed in India. One way it is a very good indicator because one company is aggressively taking over the other. But there is another story which has been brought out. And the story is very simple, that the propensity to share the fortune in the form of sharing the internal surplus with your shareholders is much more in Western countries than in India, point one. Indian people seems to be spending a lot of money for acquisition. That's why no one can wait for a long-term investor in a company, and they are looking for income by monetization of a transaction in the market because sharing from the company's side is low. What is your take on this point? How do you see it's a correct conclusion? Do you see things are changing? Do you see things are not changing? How do you feel about it?
A very complex question and multiple parts to it, but fine, let me attempt to answer it. If you look at cash distribution, one of the points mentioned by Dr. Basu is that, let's look back. Today, the Indian promoter group holdings in the companies, I mean, very few companies in the world have 50%, 60% promoter holding. If you look at TCS, the largest cap, but, I mean, I was associated with that. When we went public, about 85% or thereabouts was held by Tata Sons. Today, close to 70, 71% is still held by Tata Sons. If you look at Wipros, I think 72, 73 is held by Mr. Azim Premji. The promoters have such high holdings in the companies, so they prefer to retain their earnings with them because
What happens to minority group?
Yeah, they control the company and they keep it. The minority group, unfortunately, despite the rules and the Companies Act, which has investor protection laws for protecting the minority shareholders, is not really effective the world over. There have been corporate actions. People in India also have taken steps to prevent a promoter from doing something. I will not name the company, but there was one company where, despite the company not being too well, the promoter went and bought an aircraft. The shareholders, led by the institutional shareholders, and who have taken the place of minority shareholders in a big way, resisted the transaction so much so that the whole deal had to be cancelled. If you look at the recent case of Suzuki setting up a plant in Ahmedabad, it happened last week. There were huge objections raised by the institutional and other shareholders, which in turn did reflect the views of the minority shareholders. And Suzuki had to step in and clarify, and thereby the stock price moved up sharply after going down on this very move. So there are ways and means to protect minority shareholders. The large institutional holders have taken steps to protect their interests, they protect their investments, which in turn has benefited investors like you and me. Now, I think what was the other question?
My point is that, do you think that the propensity to share will improve as the fortune goes up?
If you look at it, it again depends company to company. Like Max Telecom, which sold off, I think you must have been there, Kotak and I think SR bought a large stake, and they distributed huge dividends at that time. I think it's about 200 rupees on a 10 rupee share. I'm talking of, this was 97 if I recall correctly. Recently, I think Strides Arcolab has also given out a huge dividend payout.
That way Bamalodi pays 200 rupees.
Yeah. So it all depends on the basic thing. If you look at Infosys is sitting on a huge pile of cash. They're paying out dividends every quarter, so they're sharing out. Yeah, Reliance is, but they're using it for expansion. TCS is generating cash and they're paying out dividends every quarter. I think among the first few companies that started paying out dividend every quarter because the money was going back, bulk of it was going to the promoters, Tata Sons. I think Wipro also pays out high dividend payouts. If you look at Sun TV, which is again about 70% controlled by the promoters.
But आपको याद करना पड़ रहा है, it is not a general trend.
It is not a general trend because companies in India do conserve their cash.
So I have to come to market to gain some money out of it without tax.
But agreed. But at the same time, if you look at these companies which are not paying out, have shown fantastic returns. Like Infosys is one example.
What do I do with that? I don't have money.
They're expanding. They're expanding and they're growing. Okay. What is happening is by conserving the cash, they're looking at good acquisitions.
Right.
They're looking at opportunities to set up their, new centers for development where they get huge depreciation benefits, which in turn lends to increasing of valuation of the companies.
Okay,
So it is a
okay.
there's no rule which says that this is Microsoft. Microsoft also sitting on tons of cash. So is Oracle. But they're not making huge payouts.
Okay, those
So
are
it
sweet
is not
exceptions.
something, it depends on a case-to-case basis. And in India, unfortunately, I don't want to be quoted on this, but the bulk of it is driven by what promoters need.
Uh,
So that point, one has to accept that. And that is the way the company is
Arjun.
run.
It is a controversial question. We have the last question. The question will go to Amit to start with. And then we have another just by my watch 3 more minutes before we open the session to the floor for 15 more minutes. Amit, it comes to you. So long and so forth in this last about 1 hour, we have spoken about all and everybody and anybody other than us. Of course, we came to you for a while, you are a researcher. The point I'm trying to make, that it is not the investors or the corporates or the regulators are going to make the market a happening place. There are facilitators in the form of brokerage firms, institutional investors, there are mutual funds. They have also a role to play because they are also thriving out of capital market. So the time for introspection with a simple question that have we come to the age or come to that level of quality, speed, delivery, to that level of transparency, honesty, which are our peers in overseas countries are? Or is there a need for this group of people who are in the market playing with others' money or advising others to play with their money have to look at and build themselves up, develop themselves also, so that Indian capital market becomes a happening place? After your comment, I think one comment each from all of you would be preferred within quick few minutes.
Yeah, I think we could do a quick survey. How many of you trust your broker? That's the basic question to answer. And there was an Edelman survey, which, this is a global survey, and they ranked financial services as the least trusted amongst all the industries. So I guess it's not just India, it's probably the global financial services industry, of which brokerages and money managers are a part of, who've got to be really concerned about that part. But coming specifically to India, I think the whole industry has obviously gone through a certain maturity curve, especially in the last decade or so, obviously helped a lot by the kind of growth that we saw. So there was money available to invest in technology, in execution capabilities, in the manpower. So in that sense, I think the capabilities are certainly at par with the best in the globe. I would probably say that Indian analysts would rank pretty high in terms of their capability, in terms of their analytical skills. Where I do see a gap, and something that I address at multiple forums, is probably the communication. I think in India, we're probably used to saying things in a very different manner. And what can be said in 100 words, we are used to saying that in 1,000 words. So I guess that's something that industry probably needs to get more and more active about. In terms of the way it could move forward, I think there has got to be, again, a significant thrust towards building up quality manpower, because ultimately it's a people's business. That's what will drive comfort level. Technology may have its own role, but ultimately it's the people, the quality of the people, to put out quality products, decipher information. Is that what will make the difference overall?
Yeah. Again, that brings me back to my pet topic of technology. You see, the brokers, earlier you got a contract, a handwritten one or a computer printed. Today, every trade which you do is time-stamped, date-stamped, right to the minimal second. So there's no question of you're being cheated. So I think the level of trust in the broker has gone up phenomenally. What Amit has rightly said is that communication is a problem. What can be said in 100 words, they're using 10,000 words. That's very correct, because what you get by way of research reports and all, especially your draft red herring prospectus, as it's called, as Vikram just mentioned, 350, 400 pages. Believe me, except for the TCS prospectus, where I was working on it, I have not read a single prospectus in detail. And I'll be candid enough to tell you that TCS had to do it because that was my job, because we were signing off on it.
The guy who reads it is the CFO because he has
Yeah, because he has to sign off out, and the merchant bankers. The other thing is quality of people. I have a slightly different perception from what Amit is saying. The quality of people has improved dramatically. I mean, I'm seeing young kids coming in today who are really putting in long hours. They are tearing apart the balance sheets and doing a lot of good work. And I'm sure Kishan Bhai here will second me on that because, as I said, he's one of the pioneers of research in India. And he's, I don't know, n number of people is probably trained in analyzing balance sheets and understanding and asking the right questions. So I think there has been a dramatic shift in the quality of people. And that's a very good sign. So I think there has been a transformational change. Always there is, of course, a scope for improvement. It's always there. I mean, I'm not saying we are perfect, but nor is the West. You have had frauds in the West, but the difference between India and the West is that if there is a fraud in India, the markets don't close. Okay, fraud has happened, get on with the job, prosecute the guys. Like bearings, which collapsed, okay, in 3 days the company was sold, it was up and running. Harshad Mehta scam, still today you're trying out, and Ketan Parekh is being sentenced today, if I may, use the names. It's ridiculous. I mean, I was working with some foreign investors. They very clearly said, okay, fine, fraud has happened, chalo. It happened. It happens all over the world. It's never going to stop. Tomorrow something else will come up. But move on, get the job done. Don't paralyze the entire system. In 92, I'm sure Mr. Damani and Kishan Bhai would recall that Harshad Mehta scam, huge problems, markets were closed, and a lot of tension all over the place. Sorry? Still not solved, exactly. Still not solved.
Vikram, I'll come to you. Quick half a minute comment on it. Very quick half a minute comment.
Sure. I think we've come a long, long way since in terms of, and I continue to use the word self-regulation because I'm a believer of self-regulation. How many people read the annual reports of the company in which you are invested? There's a very wonderful book that was written by Ian Rand called Fountainhead, where they say that architecture is about a living human being kind of a thing. So the moment you enter a house, you have to understand what is the psyche of that house kind of a thing. I think the same thing goes for corporates. The moment you give the name of a corporate or a promoter, I'm sure Mr. Damani or Kishan Bhai will say, I mean, they have a 40-year track record or a 30-year track record of that company ever since it came out to the markets and the first annual report. So in my mind, I think there is no better thing. Even if you have a wonderful broker, please spend time in going through what you are trying to invest in.
Thank you. Ramesh, just one comment, then we'll go.
Sure, that's great advice. Invest in what you know, understand. I can only say this is a very young audience out here. You're going into your great earnings year for the next 20, 25 years. My strong advice to all of you is start early, start investing early and invest wisely. If you do that, the power of compounding will mean by the time you're 50, 55, you'll be richer beyond your dreams. So please, please start investing early. That's the trick to getting rich in this in India today.
Thank you. Thank you so much. And the now floor is open. Please address your questions by name of our panelists, or I will take the liberty to direct it to the panelists. Please be brief and don't try to give your observations in too many words. Please be brief and also give your question in a pointed manner so that we can have as many questions as possible. I think Alok, you will give me 5 more minutes time. So we have 15 minutes time to handle your questions. Please go ahead.
My question is for Mr. Damani. As you mentioned that every bull market is built on a hypothesis which you can see over the next few years. So every bull market also has a certain sectors which lead the bull market. Like maybe from 2008 to 2013, we did not really have a bull market, but we saw pharma shares really soaring. So that story can be seen right now where Indian companies are really gaining market share in the US. So what according to you, 2-3 sectors which will pan out into a new bull run for the next 2-3 years or 5 years?
Great question. Every bull market has its leadership. Technology and pharma are well known, but they probably continue to do well. If you're looking at new sectors to look at, I would suggest you look at media. I think Indian media stocks are fairly cheap. You look at the e-commerce logistics sector, that's going to become huge with internet penetration going up in India in the next few years from 10% to 40%. I think there'll be a huge boom coming in that area. So those are two sectors to start looking at.
Yeah. You shout and raise, don't waste time.
My question is, last Sunday, Swaminathan Iyer had an article in Times of India. He said that FIIs are investing, whereas the Indian investors are selling off. So do you think that Indian investors are not confident in the Indian growth story so much as the FIIs have been in recent 2 months or so?
Your question is to whom?
It's okay.
Anyone.
Anyone.
So, Vikram, would you like to take this question?
So I think this is this classical dilemma, whether it's the start of the bull market, middle of the bull market, end of the bull market. You see typically retail investors, the hypothesis is the retail investors get in at the end of the bull market. Whether it is FIIs buying, whether it is Indian guys believing in the story or not, most FIIs that are investing in India today have Indian fund managers sitting outside India. Number one. Number two, I think when we're looking at some of this data, we have to dig 2 levels deeper, in my opinion, that if Indian mutual funds are selling, is it the fund manager who's selling, or is it the intrinsic or the retail investor in India who's selling, because of which there is a little bit of a redemption pressure on the mutual fund out here? And why is this happening? I think there are 2 things. So it's again a function of at what level have you gotten. Today, the markets are at an all-time high. A lot of stocks, or if you have been an investor and you have invested in a mutual fund with that NAV of 10, after 7 years, you're getting at least 10.1, you'll say, get out. It's a frustration. And you're saying, at least I'm getting my principal back. So maybe this is a phenomena that could be happening as to why Indian guys may be selling off. And when I'm saying Indian guys, it could be, so people who are sitting on dead portfolios where the portfolio was not getting churned for 5 years, 7 years, or 10 years, are looking at those portfolios all over again and saying, oh boss, at least I'm getting my principal back and let me sell off. Part of the volume in the Indian markets today could be a result of that. I think Mr. Damani will be in a better position, in my opinion, to even react on this.
Would you like to?
No, I think he said it well.
Next question, please. Yeah.
Sir, I have.
Pratik.
This is for Mr. Damani. If you read anytime Mr. Buffett, for him, risk is defined as permanent loss of capital. But if you look at the modern portfolio theory essay, it defines risk as a form of beta. For him, risk is defined differently. We can say that both are different kinds of investing. So I wanted to get your views on that.
Follow Buffett. It's pretty simple, actually.
Okay, next question, please.
My question is to Mr. Amit Khurana. So if you see in the last one year or so, there has been lots of activity in e-commerce front. Like we had IPO of Just Dial, and if you see in newspapers, every second day there is news like Flipkart raising around 30 million or Jabong raising around 30 million. So how do you see the IPO coming through for all these companies? Like if they come with IPO after 1 or 2 years, will the response be tepid or enthusiastic as Just Dial?
That will depend whether you're on 40,000 on the Sensex or on 20,000. But I think, yeah, I mean, there's a significant level of activity going on in the Indian e-commerce market. But obviously, over a period of time, some of these names will eventually get listed and they will command some significant valuations. We're already seeing, being in the unlisted status, they are demanding some astronomical valuation. So eventually they will be. What kind of response is, it's very difficult as to how the models will evolve. You know, these models have to evolve every couple of years. So whether, 2 years down the line, 3 years down the line, whether they, and most of these, as I understand, and maybe Vikram can comment better, I mean, they're not going to make money over the next 3 to 4 years, maybe even 5 years. Some of these models are actually running on a projection of a decade loss. But I guess it's the wave which is catching up, and eventually that's going to be the way of our lives going forward. They will command a decent valuation, I'm sure.
Vikram, will you chip in for a quick comment? Very, very quick comment. Whatever.
Honestly, somewhere in my heart of hearts, I don't understand e-commerce valuations. And I think it could be the next dot-com bubble that could have happened, irrespective of whatever penetration that may be happening in terms of e-commerce businesses. That's my personal view.
Thank you. Any question more? Anybody? Because Mayank will also do his observations and he will also do a valedictory comment. We'll take last two questions, okay?
Good afternoon, sir. My question is for Mr. Damani. So, as you said, one should start investing early, and it's a very basic question. So, how would you suggest a first-time investor to go about it? Because as also one thing came out from the discussion that we have huge amount of information available at our hand. So, how would you suggest a first-time investor to actually pick relevant information from the misleading ones?
You know, one way to do it is, the way to do it is always to invest in great businesses that you can hold over periods of time. Now, a lot of businesses don't meet that test of time. So, you know, a tobacco business, an alcohol business, a logistics business, these are almost permanent businesses. You know, there'll always be a need for those kind of businesses. But the other way to do it, and more sharper way to do it, as Buffett has said, is find a circle of competence that you are capable of. If you are in the finance market, look at financial stocks. You'll have a better understanding of how a bank does, how a brokerage business does, how an insurance company does. If you're a doctor, maybe look at pharmaceutical stocks, because you have better understanding who's coming out with a new cure for diabetes, what is the best cure for high blood pressure, which is the best new biotechnology company around. So my suggestion is build a circle of competence. Maybe you like FMCG, maybe you like finance, maybe you like infrastructure, and then try and find stocks within that area. It's a process. It doesn't happen one fine day.
One last question from the floor. Yes.
So it's a basic question. Like while investing, we can analyze how to invest, but how do you decide when to sell off the stock or get out of the investment?
Questions for me?
Yeah, yes, sir.
Great, thank you. You know, the first part to get right is to invest it and to make the money. How to get out of it? Well, some great businesses you hold forever. You don't sell an ITC or you don't sell a great company, because that business will do well irrespective of the business cycle. It will underperform, then it will overperform, but your CAGR will be 18, 19, 20% over long periods of time. Otherwise, the short answer to that is, if you think the bull market is ending, and there are lots of signs you can figure out that the bull market is ending. When the panwala starts giving you tips, for example, that's a good sign that the bull market is ending. That's when you sell your stocks. Because you know, whenever a bull market ends and a bear market starts, stocks will be down 50, 70, 80% from their peaks. That's a good time to sell. Secondly, if you don't understand the valuation of business, if you think that a business is worth 100 crores and the market is valuing at 1,000 crores, get rid of it.
Thank you so much. I think we had a wonderful panel discussions, and I'm extremely grateful. You have done a wonderful job. Thank you very much indeed. Looking forward to see you again with us. Thank you so much. Thank you so much. Thank you so much. With this, we end this panel discussion session. At the first, okay. So shall we?
I'll just invite, sir, a big thank you to the panelists and to Dr. Basu for conducting out such an exciting and educative session that we had. We learned a lot of simple things that were, if implemented, will be definitely creating significant impacts for us as students. We've learned a lot of things and we'd really like to thank you on behalf of NMIMS, MBA Capital Markets and BSc Investor Protector Fund. Big round of applause for the panelists and the moderator, Dr. Basu. I would like to call Dr. Joshipura, Chairperson, MBA Capital Markets, for the vote of thanks.
Mayank, we would like to listen to you for a few minutes.
I'll share my observations. Well, I'll do a dual job of vote of thanks and to summarize this discussion and maybe sharing few of my observations. But I'm sure that you all must be thrilled, right? Because you are at the age where, as Mr. Damani suggested, that you are going to get your first paycheck, and I'm sure you are not going to spend all money, and then you will start saving. And there is no better time than saving as early as you can. Just taking some summary of this discussion, I mean, we got very diverse perspective. Mr. Damani told us what we should do when it comes to investing and creating wealth for ourselves. Start early, find good businesses, and remain invested as long as you can, probably till the time you don't need that money. So that is one thing which is difficult to do, but if you can do that, I'm sure you will make great fortunes out of it. He also took us through what happens in terms of market and in terms of real economy. So we have seen that he has shared market behaves as a leading indicator. So it starts moving first, and then you start seeing signs of green shoots and further prosperity. Mr. Seth, he identified areas of concern in terms of what we refer as too much of regulation. Ideally, what is suggested is that regulation should be more of an enabler rather than a constraint in terms of doing few business or the free business. So regulation is something what we are looking for, which facilitates a transparent way of doing business, at the same time protecting investors from any fraud or any such thing can take place in the marketplace, as we see it happens quite often despite of several regulations. Incidentally, we are doing this program with a lot of support from Investors Protection Fund. So regulation is one of the way in which probably if it's implemented in right fashion, we can protect our investors. Mr. Marfatia highlighted technological aspects of the market, and there is no doubt about the fact that the transparency has increased in marketplace, the trading and transaction costs has come down significantly, and the speed of transaction has gone up significantly. Together, it has reduced systemic risk from the market. So we hope that, if at all, we don't hope that way, but if at all we see any further scam going forward, at least markets won't stop. So we'll have that system in place. Obviously, Mr. Khurana, and he must have a different view. He has to give a perspective of an analyst community as a whole. And what he has rightly said is that things have advanced quite a bit. We have a lot of talent with us, and the level of research has gone to a stage where we get a lot of information almost in real time without spending too much of resources in terms of time as well as money. So the question is how best we can use that. Based on this entire discussion, I observed certain things, and I thought I'll share something from my side so that when you go out into the market and invest, you probably don't make the mistakes which people would have made in the past, and you take the things accordingly. The first thing is, well, in hindsight, everything is explainable. So all bubbles and scams were predictable in the first place, be it .com or subprime or whatever you say. Having said that, one thing is certain, that if you stay invested for a reasonably long period of time in equity, you are going to create a lot of value for yourself, your family, and maybe for your friends also if you earn beyond something what you really expected. One small thing which we need to keep in mind, while world over, among known and developed markets, we have evidence for long-term positive returns. If we don't go for the analysis, Japan is a spoiled spot in the market. In 1989, it was close to 40,000 Nikkei. Right now, it's struggling at around 14,000 plus or less than 15,000. So in 25 years' time, if we consider that as a long term, it has not even recovered its capital. So that is something which is a one spoiled spot as far as global equity markets is concerned, and we can analyze why it has happened. It's a different issue altogether. A second thing on holding on to good businesses, and believe me, that's something which is really great. I mean, we should invest in businesses and stay there for a long period. Probably two things are happening here. One is what we define as disposition effect. So it's like holding on to winners for how long? So if we ask that question, Infosys, ITC, Wipro, people who would have invested during ITC or IPO of those companies, how many of them are holding those stocks now? So that's a big question and challenge. Can we have that patience to continue holding such great businesses? The tendency, as it has been observed in the marketplace, is selling off winners too early, holding on to losers for a very long period of time. Infosys, I remember on 9th April 2003, in a single day fell by 33%. The question is how many of them continue holding it? Or the similar thing would have happened in 99. So that is a big challenge as far as investing in right businesses without worrying about short-term volatility for a long period of time. Third thing is on analyst estimates. I'm talking about some of the estimates from blue-blooded brokerage houses, not from India, overseas. Recently, I saw some earning or the earnings report for the third quarter and the estimates, the way they are revised. The market price for a known stock was it was around 370. One of the leading European firm, which gave a forecast of 210 for next year, the other gave it 550. And probably the understanding which they may have derived is one is analyzing from a virtuous circle point of view, another is from a vicious point of view. Believe me, only one of the two can be correct, not both. So that is something which is, you need to figure out which one you believe is right and which one is wrong. Performance of mutual fund industry in India, it seems that it has not done reasonably well because the size of MF industry has gone up all the way up to about 6.5 lakh crore in Indian rupee terms in year 2003 itself. What I understand right now is hovering around 9 lakh crore and not beyond that. If you simply take then market cap or the market capitalization of India as a whole versus you compare with today, it should have grown much beyond this. That shows that they have not delivered what investors really expected from them. In India, we have dividend as well as capital gains, both tax-free. But one thing which is concerning, if you look at dividend, in your hands it's tax-free. But the dividend distribution tax, which is close to effectively about 17%, so if a firm decides to distribute your money, to address Dr. Basu's issue on why we don't distribute, I am really asking other way around question, is distribution good for investors, especially small investors? Because if you are not looking at control, you can sell off some investment after 1 year because you are not worried about what percentage of ownership you have in company. If company tries to pay you dividend, it may end up shelling out 17% to government of India and no one else in that case. I'm saying that from a government's point of view, it's good, but otherwise it's a question mark. The difference is not significant. Maybe on Sensex and Nifty, the dividend yield is hovering around 2%. On S&P 500, it's around 2.5%. So it's not that bad when it... So that is one. And the last thing is, we all should be much more comfortable in terms of the way markets are developing, say before what we, the veterans have seen 20 years back. Recently, we have seen that potentially we may get some bit of EPFO money coming into the marketplace. The pension funds are developing into Indian market. And with that, there is a potential for long-term sustainable capital flowing into the Indian markets. To that extent, our reliance on foreign money or FII's money, to say so, will come down and probably we'll see much less volatility in the marketplace. So these are certain observations at my end. Let me move to my second job now, is to share vote of thanks. I start with the panel members because they are the one who made this event happen and made you all excited by sharing their expertise and views, and the quality and the number of questions, the way we have seen from your side, it seems that you have derived a lot of benefits out of that. So my sincere thanks to all panelists, Mr. Damani, Mr. Seth, Mr. Marfatia, and Mr. Amit. So I also would like to share my thank, though he could not make it, to Mr. Jai Shankar, and he was willing to come, he could not, so we extend our sincere thanks to him also. Uh, we would like to give special thanks to Mr. K.R. Choksey. Our biggest thank goes to him, in fact, because he has been the one who was instrumental in terms of facilitating mutually beneficial collaboration between Bombay Stock Exchange and NMIMS, and we have seen the fruits of that. We are doing the 7th edition of Investocraft. Our program has been doing fantastically well. So we seriously thank Bombay Stock Exchange, in particular, Mr. K.R. Choksey. We also would like to extend our special thanks to BSC Investors Protection Fund, because they have been the one who have provided support both in terms of financial and otherwise to conduct this event year after the other, and we have derived a lot of value out of that. I would like to extend our thanks to Dr. Sanyal, who has just left after inaugurating this event, and Dr. Saxena, the Vice Chancellor, NMIMS University, for providing us continuous guidance and support in terms of making, organizing such events and make them successful. My thanks to Mr. Mehta also for representing Bombay Stock Exchange and delivering an interesting initial speech. Last but not the least, let me thank all of you, especially the organizing committee of Investocraft. You have done a very good job in a very short span of time in making this event success. All the participants, and especially one of my colleague, Dr. Sangeeta, so she has made it for the event. So thank you all. Last but not the least, I reserved that for the end. Our own Dr. Paritosh Basu. I always felt that we should have someone who can drive the panel discussion in right direction and can take advantage of the expertise of experts in a right manner so that we derive maximum benefit in minimum possible available time. I don't have to say anything. He has done a fantastic job. At least that is what I believe, and I'm sure you all agree with us. Once again, my special thanks to all the panelists, Mr. Damani, Mr. Seth, Mr. Mafatia, Mr. Khurana. Thank you all. Thank you all. We end this session here. Please join us for high tea from here on. Thank you.